Well, good morning, everybody, and welcome to our traditional post-fiscal event analysis. I'm Paul Johnson, Director of the IFS, and as ever, I will start by reading or going through some opening comments on yesterday's fiscal event, to the extent that it was a fiscal event, and then three of my colleagues will go through in rather more detail some of the specific aspects, and in particular, Isabel Stockton will look at the public finances. B. Boileau will look at public spending. And Tom Waters will look at the welfare changes. Anyone listening can or watching live can add some questions to Slido in the normal way. That will open after I finish my opening remarks. Once I finish the opening remarks, we'll move straight on to those three presentations. And then we should, with luck, have somewhere between half an hour and 45 minutes for questions. Whilst this was, as Rachel Reeves promised, not a major fiscal event, there's still plenty to talk about. So not a major fiscal event. There weren't any tax changes, really. The two substantive spending changes had actually already been announced. The cut to overseas development aid spending to fund higher defence spending was announced a little while ago, and most of the changes to working age benefits were announced last week. The only other really significant change was a shaving of assumed increases in day-to-day spending for an average of 1.3% a year increases after next year to 1.2% a year. That's not totally trivial, but it's not exactly a huge change. So the cuts to day-to-day spending, a little bit of revenue from increasing tax compliance, an assumed boost to growth as a result of also previously announced planning reforms, they were just about enough to undo the fiscal consequences of economic and fiscal forecasts that had deteriorated since the autumn. In fact, as far as the Chancellor's key fiscal rule is concerned, that's the aim to be borrowing only to invest in 2029-30. The changes weren't so much just about enough to restore us to where we were in the autumn. They were absolutely bang on precisely enough to do so. We have £9.9 billion of so-called headroom in October. We have £9.9 billion of headroom today. And astonishingly, and we couldn't quite believe this when we looked at the numbers, they're actually within £2 million of one another. I mean, that is that is at sort of subatomic level in terms of scale of precision. It's hard to believe this is a fluke. The Treasury has clearly worked overtime to ensure that precisely the same fiscal headroom remains today as was projected in October. I have to say that's not a terribly sensible use of their time or way of making policy. Indeed, one can see the consequences in the cuts to the health-related benefits over and above those that were announced last week. Whilst unquestionably tough for those on the receiving end, those original cuts were entirely defensible as a response to problems manifested in the huge increases in the numbers of claimants and in spending. One can make a defence of them entirely unrelated to the details of any particular fiscal rule. But coming back just a week later with just a slightly bigger cut, because that's what's needed to return the fiscal headroom to precisely where it was a few months ago, in my view, risks undermining the quite strong case and discrediting attempts at genuine reform to the benefit system. If it was right last week to announce a halving of the health component of universal credit, it's hard to see why this week it's right to do more than that by halving it and then freezing it in cash terms. I rather fear the Chancellor has missed the policy wood for the fiscal trees. And despite this oh so careful maintenance of the fiscal headroom, the worry for Ms Reeves is that headroom remains very small indeed. As she observed time and again, we live in a risky and changing world, as President Trump's actions overnight on tariffs demonstrates all too well. There's a good chance then that economic and fiscal forecasts will deteriorate significantly between now and an autumn budget. If so, she will need to come back for more, which will likely mean raising taxes even further. And that risks months of speculation over what those tax rises might be. A raid on pensions, a wealth tax on the richest, another hike to capital gains tax. I mention those not to commend them, far from it, but to exemplify the kinds of taxes regarding which mere speculation about increases can cause economic harm. With no sense of a tax strategy, we have no idea which way the Chancellor might turn. So let's look at those economic and fiscal forecasts. A £14 billion change in the forecast of the current budget deficit 5 years out is nothing special. This is not anything to do with dramatic changes in the world. The need for fiscal action arose not so much from that any huge deterioration in the forecast as from the tiny amount of headroom the Chancellor left herself back in October. While she plugged the hole in the sense of getting the headroom back to the precise same level as before, she allowed herself considerably more borrowing, it's worth saying, in the interim. Total borrowing between now and 2029-30 is expected to be nearly £50 billion more than forecast in October. It's worth remembering that. And that's a consequence of weaker economic growth in the short run and higher spending on debt interest later on. Now, the OBR reckons there's only a 54% chance that on current policy we'll actually get to current budget balance by 2029-30. And of course, current policy includes, increasing fuel duties every year. More remarkably, it puts the chances of meeting the second fiscal target, that debt, or more precisely public sector net financial liabilities, should be falling in that final year. It puts that probability at a mere 51%, an absolute coin toss. And that's despite a redefinition of debt, which left much more space than the definition used until last year. Indeed, it's worth noting that the measure of debt inherited from the last government, public sector net debt excluding the Bank of England, is set to rise in every year of the forecast period. The fiscal rules might be ironclad, but they might well need a good deal more cladding to keep them going in the future. And it's the combination of that ironclad pass-fail numerical fiscal rules and next to no headroom against them that's causing so many problems, leaving fiscal policy completely exposed to economic developments outside the government's control. Now, that is not conducive to a sensible policy-making process. That's not the OBR's fault. It's the product of the Chancellor's own choices. Now, given all the uncertainty, the OBR has not changed its view of the level of GDP in 2029-30 by very much at all. Lower growth this year is largely offset by higher growth in later years, and it's worth saying that the OBR remains considerably more optimistic than other forecasters in that sense. But it does stress the sensitivity of forecasts to a range of variables. Problems associated with interpreting recent data on GDP, productivity, and the labour force don't help. They make things especially uncertain. To repeat what the Bank of England and now the OBR has said, the quality of ONS data is becoming increasingly problematic for the appropriate management of the economy. To illustrate the degree of sensitivity, if the OBR were to downgrade its view of trend productivity growth to halfway between its apparent recent level of 0.3% a year and their current forecasts of 1.25% a year, that would take the forecast current budget deficit to something like 20 billion in 29-30. There's obviously a big downside risk here. On departmental spending, well, it was already evident in October that the spending review in June is going to be seriously tough. Changes made to spending assumptions yesterday make it slightly tougher. On average, day-to-day spending will rise by 1.2% a year from next year, rather than the 1.3% penciled in at the budget. Compared to October's numbers, that's a reduction of just over £1 billion in 28-29, the last year covered by the spending review for day-to-day spending, and of £3.6 billion in 2029-30, the last year of the forecast and the crucial number for the fiscal target, but outside of the spending review period. I think we can take that final number with an enormous pinch of salt, being outside the spending review period. History suggests, and I'd actually be willing to take a bet on this, that number will be topped up. The spending plans are even more front-loaded than before. Spending growth is now set to be 2.5% in 2025-26, then 1.8% the following year, and then just 1% in each of the subsequent 3 years. I think it would be fair to be, shall we say, sceptical of these plans, to be prudent, but only in the future. Front-loaded or not, though, the problem for the Chancellor is that keeping to these growth rates overall will inevitably mean cuts for some departments in the years to come. You'll get a lot more detail on that from B in a minute, and that's also far so familiar. But I do want to spend just a bit of time on the specific issue of the cut to overseas aid spending and the rise in defence spending. On the face of it, it's a simple switch from one to the other. Cut aid, fund defence. And that's very much how the decision has been presented. But is that really the case? I ask because the composition of the overseas aid cut and the defence increase are very different. Almost half of that cut to overseas aid, £3.2 billion, is day-to-day spending that counts against the main fiscal rule. In contrast, only 0.6 billion of the increase in defence spending was an increase in day-to-day spending. That switch makes balancing the current budget easier by £2.6 billion. That's Rachel Reeves said that, skated over it, but she said that yesterday. So this raises two issues. First, if we hadn't cut aid spending, so in the absence of the cut to aid spending and the much smaller increase in current defence spending, meeting the fiscal rule by the same margin would have required bigger cuts to other departments. Because the Treasury was clearly targeting that precise 9.9 billion of headroom, this suggests it was always going to target a particular level of savings from day-to-day spending. Now, given that, the main thing that the cut to day-to-day overseas aid budget seems to have achieved, apart from the cut to aid itself, of course, is actually smaller cuts to other departments than otherwise would have been possible. There's been almost no switch of current spending from overseas aid to defence. So, is that really funding defence? Question. Second, at present, about 35%, so just over a third of the defence budget goes on capital. Yet the government has decided that more than 90% of the extra spending will go on capital. That may be the right option militarily. Frankly, I'm no expert, I have no idea. But the stark difference between the capital current split in actual defence spending and the split in the intended uplift, and the fact that the 2.6 billion saving, relative to a rather convolutedly constructed counterfactual, it has to be said, that £2.6 billion saving depends entirely on this pronounced, might say extraordinary focus on capital spending. It does raise the question, at least, of whether the fiscal rules have influenced the composition of the defence spending switch. Finally, let me say a word about the working age benefits. Much of what was announced was not new. The key elements were set out last week by Liz Kendall, including halving the health-related element of universal credit for new claimants, freezing it for existing claimants, and tightening eligibility criteria for personal independence payment, or PIP, alongside a very unusual permanent increase in the basic rate of universal credit. Now, the Chancellor yesterday added to those changes a long-term freeze to the new lower health element of universal credit for new claimants. She also slightly, very slightly reduced the promised uplift to the basic rate of universal credit. Altogether, the OBR scores a saving of £4.3 billion from these changes in 2029-30. Now, 4 quick observations here before my colleagues say a little more. First, these changes are enough to mean that spending on health-related benefits for those of working age should, instead of rising in real terms from 37 billion in 2019-20 and 56 billion in 2024-25 to 70 billion in 2029-30, rise to only 65 billion in that final year. In other words, they won't lead to a cut in spending at all. They'll merely slow the rate of increase. Second, as observed at the start of these remarks, while the overall strategy is understandable, the additional cuts announced yesterday look to be there merely to meet a fiscal target. They don't give confidence in the rationality of decision-making. Third, in truth, the scale of the savings is really most uncertain. The OBR's costings assume almost half of those who would lose eligibility to PIP if they didn't change behaviour will in fact act successfully to maintain eligibility. If people don't respond like that or can't respond like that, savings could be actually significantly higher. On the other hand, it has to be said, and this is why the OBR, I think, made those assumptions, previous attempts to save money on these sorts of benefits through tightening eligibility criteria, including the introduction of PIP to replace the old disability living allowance, were spectacularly unsuccessful if what they were trying to do was save money. Fourth, the savings, and hence the numbers affected, by 2029-30 are actually a major understatement of the long-run effects, as new claimants will continue to roll on to the lower and harder to qualify for benefits, and more current PIP recipients are reassessed. So, in conclusion, the changes to economic and fiscal forecasts yesterday were not actually terribly big, nor were they unexpected. The main policy announcements were not terribly new. But even where not new, we did learn some things. For example, the OBR is persuaded that planning reforms will result in a lot more houses being built than otherwise, and this will be good for growth. And the scale of those effects, of course, is uncertain, but the direction is clear. And these really are the sorts of policies that the government should be focusing on and that should help growth. Government needs to maintain its focus on such growth enhancing policies and perhaps devote a little less attention to fiscal super fine tuning. While maintaining to an extraordinary degree of precision her fiscal headroom from October, the Chancellor takes at least three risks. First, she's going to have to navigate a tough spending review in June, which is going to disappoint some of her cabinet colleagues by likely cutting some departmental budgets. Second, the fine-tuning of spending decisions to meet precise fiscal targets risks undermining broader objectives. For example, rational reform of the benefit system and optimal allocation of defence spending. And third, with such little headroom and such an uncertain environment, unhelpful and damaging speculation about what taxes might be increased in the autumn are, I think, inevitable and could themselves have damaging consequences, political as well as economic. So I'm going to finish my remarks there. As I said, we will now have three presentations from my colleagues. Isabel Stockton, who will look at the public finance outlook, Bea Boileau, who will look at public spending, and Tom Waters, who will look at the welfare changes. You can now add questions to the Slido for us to discuss at the end of those presentations. And as I say, we ought to have at least half an hour at the end to go through those questions. Thank you, and over to Isabel. You're on mute, Isabel.
Thank you very much, Paul. So I'm going to tell you a little bit more about what we learned yesterday on the public finances and some of the risks that are built into those forecasts. So on revenues, we did not hear very much, but one thing to still keep in mind is that they are still on an increasing trajectory, and the largest component within them, tax revenues, are still set to rise to a level that has never been sustained in the post-war period. On spending, you'll have heard a lot about cuts in the last few days, but nevertheless, total government expenditure, a measure of the size of the state, is still set to settle at a higher level than it was pre-pandemic towards the end of the decade, and for that matter, a higher level than it was on the eve of the financial crisis. If we just look at current or day-to-day spending, that is excluding spending on investment, then we can see that by the later forecast years, that part of expenditure is covered by revenues. The difference between those two lines is the current budget surplus, and that is what the Chancellor is targeting with her main fiscal rule. So one of the reasons why spending is set to remain at that higher level is that debt interest is still much more expensive and set to remain so compared to what we've been used to over the 2000s. So on the forecast that we saw yesterday, debt interest spending is set to remain high and in fact to continue rising all the way to the end of the forecast period. In some sense, the change in debt interest was one of the biggest stories in changes between October and March, but on this scale, they actually look rather modest. And in particular, if we compare them to what has changed over the last 3 years. So if we cast our minds back to March 2022, then we are now forecasting for next year a debt interest bill of 111 billion. That is a whole 64 billion more than was forecast 3 years ago. Now, that is one of the reasons it is now so difficult to achieve a current budget surplus and meet the Chancellor's main fiscal rule. So looking back to the budget before the general election, Jeremy Hunt was planning to implement a fiscal tightening, a combination of tight spending plans and tax rises to get us from a current budget deficit to a modest surplus by the end of his forecast period. Thinking back to last October, Rachel Reeves then announced a large loosening in spending in particular, but was still committed to much tighter spending plans in the medium term and large tax rises, bringing us back to a surplus in 2029-30. Yesterday, there was another amendment to that. Now, this looks relatively modest on this scale, and in particular, we are getting back to exactly, actually, to an almost absurd degree, exactly the same point as we were in October. But it's still worth noting that in the intervening years, she is said to still borrow almost 50 billion more. So let's look under the hood of those changes a little bit more. So she started out with a 10 billion surplus on the current budget back in October. That was entirely eaten up by higher debt interest spending yesterday. Now, those of you who watched the public finances closely throughout the year will know that revenues have been falling short of the OBR's October forecast in the 11 out of the 12 months of the financial year that we currently have data for. Now, luckily, the OBR assumes that most of that effect is going to be a temporary one, meaning that revenues largely bounce back to the previously assumed level over the medium term. One of the most notable features of the forecast is that the OBR assumes a significant boost to GDP and to revenues from indirect effects of policy, that's particularly planning reform. And I'll get back to that in a little bit more detail later. Finally, there's about a 10 billion tightening on spending plans. That is split between benefit reforms and public services, both of which you'll hear much more about from my colleagues later on. That brings us back again to exactly that, just under 10 billion pound surplus on the current budget. Now, there are a lot of risks around these plans, and 10 billion is a very, very narrow margin to be meeting a current budget target by. One illustration of that is that the OBR estimates that the chances of actually running a current budget surplus in the fifth year of the forecast when it comes around is around 50-50. But I would be remiss in my duties if I did not point out to you in particular that these forecasts are predicated on the 5p cut to fuel duty expiring and fuel duty then being uprated in line with inflation in every year. If, as has become traditional, fuel duty remains frozen instead, that would be enough to eat up around half of that headroom. Now, the Chancellor in her speech and in the Red Book emphasized again and again that the world has changed, that there are global economic headwinds, and that the UK will be affected by those going forward. Now, one might think if that is your view of the world, that it's become a riskier and economically more dangerous place, then you might think that it would be prudent to build up a bigger buffer, to have a little bit more headroom against your fiscal rules in case you are blown off course by these headwinds. She chose not to do that, and instead, despite all this increased uncertainty, to only restore headroom to that same quite small level. Now, let's look at this claim that the world has changed a little bit more closely. In public finance terms, one way of thinking about how much the world has changed is to look at the change in the borrowing forecast for the fifth year between one forecast and the next. So this gives an impression of how much the OBR thinks the world has changed in a fiscal sense and in an enduring, permanent sense. So this gives you the difference between pairs of forecasts on that measure. The ones that are on the left are bad news for a chancellor, borrowing increased before policy measures. The ones on the right side are good news. The OBR delivered something of a windfall to chancellors in those situations. So where does yesterday fit in? Well, we might describe it as moderately bad news. She has been less lucky than some, but this was by no means an extraordinary, world-shattering revision. This was really not so unusual. Now, the Chancellor also has a second fiscal rule on debt. This as well is being met by a very, very narrow margin. So by the end of the forecast period, debt is stabilized on the targeted measure of net financial debt. If we look at what we might call the old measure of debt, public sector net debt, excluding the Bank of England, now that is no longer targeted, but it still matters, amongst other things, because as she pointed out in her speech, higher debt is one of the drivers of a high bill on debt interest spending. Now, on the currently targeted measure, there is 15 billion of headroom against a target of having debt falling. That too leads the OBR to conclude that there's about a 50-50 chance of debt actually falling when that year comes around. The previous measure of debt is technically no longer falling. It is rising by a tiny amount even in the last year. Now, let's get back to the impact of planning policy reform. This was one of the most notable elements of the forecast, and the OBR expects reforms to the National Planning Policy Framework to deliver a really, really impressive boost to house building. So between next year and the end of the forecast period, the number of houses built annually is forecast to rise by almost 60%. So that would be a really impressive achievement. It's not hard to think of downside risks to these plans, whether they stem from local opposition to additional house building or from supply constraints in the construction industry. But if it can be achieved, then the OBR estimates that it would boost near-term GDP, and more importantly, would add to capacity in the economy in the long term. That's through channels such as a more productive use of labor and capital, more people just getting to enjoy living in those additional houses, and effects through the labor markets, such as workers finding it easier to get access to and live near to more productive jobs. So this would have consequences for GDP within the forecast period, but more importantly, beyond the end of the forecast period. And revenues would be up around £3.5 billion by 2029-30 from this effect. So this was some good news on productivity. However, productivity is still one of the major risks in this forecast. So this is productivity as forecast yesterday. We can compare that to what the forecast was back in October. And if we take those latest outturn data points at face value, then we might conclude that recent productivity growth has been especially disappointing. Now, it's worth caveating this by saying that because there are so many question marks around the data on both GDP and hours worked, it's entirely possible that that recent fall might be an artifact of the way we're measuring this. Perhaps productivity in reality has fallen by less than that. But if we take it at face value, then it looks like the continuation of a long-term pattern. So if we look at past forecasts, it's been very, very common for those to be undershot. The OBR has provided a pessimistic scenario on productivity, where they essentially assume that recent disappointing outturns continue and there is no catch-up growth in productivity. That would leave us around this blue point at the end of the decade. Now, that would be hugely consequential for the public finances. The OBR estimates that it would leave the current budget in deficit by almost 50 billion in 2029-30. So you might, just to give a sense of scale, think about a situation where there is a downgrade to halfway between that pessimistic scenario and the current assumption in yesterday's forecast. And even in that situation, she might find herself with a need to find more than 20 billion pounds in the autumn to get back to current budget balance. That brings me to the end of my talk. So the OBR dealt the Chancellor what we might describe as a moderate fiscal downgrade. She was somewhat unlucky. She succeeded in restoring the current budget surplus precisely to its previous level through cuts to day-to-day spending plans, a combination of plans for public services and welfare, both of which you'll hear much more about from my colleagues in a minute. Looking ahead to the autumn, the Chancellor could get lucky, and we should all hope that she does, and the public finances improve. But given how narrow the margin against the fiscal rules are, she could easily find that further action is needed in the autumn budget. That will be after the spending review in June, which might mean that it becomes harder to unpick a spending settlement again if a further tightening is needed. And that in turn might mean that tax raising measures would become more likely as a solution to problems that emerge between now and then. And I will now hand over to B for more detail on spending.
Thanks very much, Isabel. Um, I will just share my slides. Okay. So I'll be talking about what we know about plans for public service spending, what we learned from yesterday's announcements, and what this means for the Chancellor going forward, particularly thinking about the run-up to the spending review in June. To start off with, plans for public spending on public services were not changed very much in aggregate by yesterday's statement. Indeed, total departmental spending on public services is pretty much identical in cash terms at the end of the forecast period, with a small fall in day-to-day public service spending and rise in investment spending, exactly offsetting each other. Higher inflation this year does mean that real growth this year looks lower, but growth rates are largely similar thereafter. In terms of the changes that were confirmed in yesterday's announcement, there were significant things for individual budgets or programs. So important changes included much more detail on the transfer from aid spending to defense spending that we already knew about, cutting some more money from day-to-day spending via cuts to administration spending and a transformation of public service productivity, and a small rise in capital spending, largely but not entirely through rises to defense spending. But really, in terms of public service spending, we should see yesterday's event as more of a confirmation of the real challenges that we know await at the spending review in a few months' time. I'll start off by talking a bit about the plans for day-to-day spending, and indeed I'll spend most of this presentation focused on day-to-day spending. Here's how planned day-to-day spending growth looks over this Parliament, as confirmed by Rachel Reeves yesterday, comparing real-term spending levels to its level in 23-24. You can see day-to-day spending is set to end up much higher. You can see the faster growth this year and next, followed by a flattening out of this line with slower growth thereafter. We can compare this with plans for day-to-day public service spending back in October. You can see that plans back in October did look higher, but this is really largely driven by faster growth in 24-25, driven by this higher than expected inflation that I mentioned. Growth is pretty similar thereafter, with these lines broadly parallel. And in fact, spending is around 4.6 billion lower in the final year of the forecasts. So pretty small changes, really. Something to note here is that this is still a good deal more generous than what was planned under Jeremy Hunt, which I'm showing here. The fast growth, particularly this year and next, in spending really shouldn't be understated. And in 28-29, spending is still set to be around 50 billion higher than it was under Hunt's plans. The key question, really, and this was the key question back in October too, is whether these plans are deliverable. On the one hand, we know that big cuts to unprotected budgets, that's a set of areas like schools, courts, and prisons, were implied back in October, and that's still the case under today's plans. And the question is whether the Chancellor will be able to deliver these implied cuts rather than topping up budgets. So over the course of the forecast period, day-to-day spending is set to grow by an average of 1.6% above inflation on average each year. But spending on areas that aren't health, childcare, defence, or aid, so traditionally unprotected areas, look like it might be cut slightly over the course of the forecast period, so falling by around 0.4% on average each year. This uses our projections for plausible spending changes elsewhere. And this is all slower over the periods covered by June's spending review, at which spending envelopes over the next few years will be allocated to specific departments. That's a result of the front loading of spending plans. So spending growth is set to be just 1.2% in real terms each year, resulting in cuts of 0.9% on average each year to these unprotected areas. Those might be pretty tough to deliver when the Chancellor has to actually lay them out. And it's worth saying here that a really substantial risk is posed by defence spending. If increases need to go further and faster than just 2% of GDP by 27-28, that could mean really substantially higher squeezes to unprotected areas of spending, or necessary top-ups to the total level of spending, or more likely some combination of the two. Among other things, delivering these sorts of potential cuts to unprotected areas will require some public sector pay restraints, pay rising less fast than in the private sector, or headcount cuts in the public sector, or some combination. And these headcount cuts are likely to come from frontline services. They come on top of the admin savings, which we were told would be made in this statement. So I'll tell you a bit more detail on these admin savings now. The Chancellor confirmed plans to cut £2.2 billion from administration budgets in 29-30. That's relatively small fry in the context of total day-to-day spending, but it's pretty significant in the context of the current level of administration spending, representing around 15%. This would more than reverse the increase in admin costs that we've seen take place since the start of the pandemic. It's not undeliverable. We saw a comparable cut under the coalition government, a 23% cash terms cut in the early 2010s. But it's fair to say that efforts to reduce admin spend in the 2000s were somewhat less successful. And to illustrate this, I'll show you something that we at the IFS made earlier, back in 2004 to be precise. So here we were thinking about how admin spending actually changed compared to successive projections for changes under the Labour governments of the 2000s. As you can see, admin spending was consistently projected to go downwards, reflecting these big promises to slash admin spending in the 2000s, but admin spending fairly consistently continued to rise. So that's another risk to the deliverability of these spending plans. And the final challenge is that, as we emphasised back in October, and as remains the case, these plans are really very front-loaded, in that growth is faster in the earlier years before being cut back thereafter. As with administration savings, we have some historical precedents drawn here when thinking about whether this degree of front-loading is deliverable. In the 2000s, the last time we had overlapping spending reviews, we had faster growth in earlier years. When it came to revisiting, for example, the 1998 spending review in 2000, the slower growth in the final year was topped up, as you can see. A front-loaded pattern was again penciled in, and you can see through the 2000s this consistent pattern of penciling in these front-loaded spending reviews followed by top-ups to the final year of the forecast. We see a similar picture thinking about the 2021 spending review, front-loaded, and the Labour government's top-up to the final year of the spending review when coming in, penciling in their own front-loaded spending plans. And in fact, when the Chancellor tweaked day-to-day spending totals yesterday, growth over the course of the spending review was in fact specified to be more front-loaded. So you can see this top-up to growth rates in 26-27 before a bit of a cutback thereafter. And again, there's this open question, is this plausible? Will we just see these slower, later growth rates topped up when it comes to spelling them out? So all this to say it might be pretty challenging to deliver these spending plans, but it's possible to overstate this. As I emphasised back at the beginning of this presentation, we're still seeing a cash injection, particularly this year and next. So total spending growth, as I said, was set to be around 1.6% each year on average over the forecast period, over and above inflation. Here I'm showing you how that compares to recent history. That's less generous average annual real growth than in the very recent past, but much more generous than in the 2010s. We're still seeing funding growing overall. And while funding for these historically unprotected areas might be falling slightly in real terms overall over this forecast period by 0.4% on average each year, and falling faster over the spending review period, as you can see here, that's still relatively small compared to the much faster pace of cuts in the early 2010s. There are also some early grounds for optimism on public sector productivity. That's particularly the case in the NHS, where there are signs that productivity might be bouncing back to some extent. And if continued, that could make these type plans much more deliverable while maintaining performance levels or ensuring they don't worsen so much. And finally, it's fair to say that the Chancellor has allocated some funding and a plan to how productivity might be improved in these administrative savings made. So this does improve the chances that these plans are deliverable. Just to conclude, I'll show you how capital spending plans have changed since October. Here I'm showing you current plans for capital public service spending over the course of the forecast period, comparing to 23-24. And here I'm comparing this to plans back in the autumn. You can see these are really pretty similar, and that the level by the end of the forecast period is set to be slightly higher, reflecting this shift a bit out of day-to-day spending and a bit more into capital spending. The similarity of these plans compared to the autumn, and the difference to Jeremy Hunt's plans last spring, which I'm showing you here, is again notable. But despite this difficult fiscal context, capital is being relatively protected. So just to round up now, we've seen these small tweaks to spending plans, and while these are significant for individual budgets and programme lines, there's not so much change to the overall aggregate picture of spending. And this continues to be the case that tough and consequential decisions will need to be made at the spending review when the Chancellor must allocate these potential cuts and these tight plans to individual departments. A really key risk here is defence increases. If these need to go further and faster than is currently planned, this could really worsen the picture elsewhere, meaning that these spending plans might need to be topped up, or that cuts to other areas of spending would be worsened. And finally, it's worth saying that the decision to protect investment spending is commendable. We've often seen governments reach for cuts to investments, and this government has not done that. And on that note, I'll pass over to Tom to talk about welfare.
Thanks very much, Bea. Yes, I'm going to be talking about the welfare reforms that we heard about yesterday. So what has the government announced? So firstly, we heard about an increase in the basic rate of universal credit, about a 5% rise by 2029, costing the government just under £2 billion in that year, with a large number of people gaining a relatively small amount. They also announced that the health element of universal credits, which you get if you're unable to work, will be frozen and for new claimants halved as well. That saves £3 billion in 2029. They're going to tighten the eligibility criteria for disability benefits, saving £4.5 billion, add an extra £1 billion into employment support programs for those with health conditions. And somewhat unlike the other policies, they also confirmed that they're going to cancel previous government plans to make it harder to qualify for the health element of universal credit. And so relative to those previous plans, that's a cost of about £1.5 billion. The government's also announced some other reforms, but not yet with enough detail for the OBR to score. So what do these policies do to the overall shape of the welfare system? So here I'm going to show you spending on working age welfare in different years, split into health-related benefits and everything else. And you can see that health-related benefit spend was 29 billion or 22% of the overall bill back in 2009. And in the run-up to the pandemic and over the pandemic, those numbers increased, and on the OBR forecast would continue to increase, reaching £70 billion going on health-related benefits in 2029 without any of the policies announced yesterday. Those policies do serve to somewhat undo that rise, but you can see it's really just slowing the increase rather than actually putting it into reverse. So even with these measures, spending on health-related benefits will be a decent amount higher in 2029 than they were just this current fiscal year that we're now finishing. But these costings are highly uncertain. The OBR label some of the key reforms as having an uncertainty rating of very high. So to give an example here, for tightening eligibility to PIP, they say that on a static basis, 1.5 million fewer people will qualify under the new rules, but that once you account for changes in the way that claimants and assessors change their behaviour, 700,000 of that 1.5 million would qualify after all. Now, of course, that's very uncertain. In reality, it could be much more than 700,000. It could be much less. But the OBR are right to be cautious about this. We've got past experience, which shows that changes in behavior can make reforms save much less than expected. So to give two quick examples, when employment and support allowance was introduced, the expectation was that it would save that 10 to 20% of people would be placed in the more severe disability group. That ended up being 70% or more than 70%. And when PIP replaced disability living allowance, the expectation was for the more severe disability group caseload to fall by 400,000. In fact, it increased by 300,000. So who is affected by these policies? So I'm going to show you here where the winners and losers from these policies are in the income distribution. So starting with winners, there's set to be 3.2 million winners gaining an average of £420 a year. And that's coming from a very large, that's coming from the poorer households. You can see about a quarter of the poorest households in the poorest tenth are gaining from the policy, and a quarter in the second poorest tenth. And if we look at losers, we see broadly a similar pattern. It tends to be lower income households that are affected by this policy, and they're losing a somewhat larger amount per year. And in fact, actually, the pattern we see here for losers actually overstates how well off the losers are, because these figures don't take into account the higher living costs associated with disability. And importantly, in the case of the losers, there's a huge amount of variation. About 38% of losers lose at least £4,000 a year. I mean, taking all these policies together, the government estimate an increase in poverty of about 250,000. Turning now to employment effects, the package generally strengthens work incentives for those with health conditions, but it might be that group that are particularly unlikely to respond. Now, the OBR haven't scored the increase in any increase in employment effects yet. They say they'll do that at the next fiscal event. But a previous cut to incapacity benefits, the one that was cancelled yesterday, they said would result in 370,000 people losing about £4,500 a year, and about 1 in every 37 of those affected would get into work. So a large number of people losing for a relatively small increase in employment. Another route to an increase in employment could be this extra £1 billion for employment support programs I mentioned earlier. The devil here is very much going to be in the detail, but based on similar previous programs, we'd expect increased employment to be in the order of tens of thousands rather than hundreds of thousands. And so taking that as a whole, these policies make up a small mitigation against the effects on policy. Importantly, there's actually more to come. So despite the fact that this is the biggest welfare cutting fiscal event since 2015, that doesn't include the effect of some policies rollout going on beyond 2029, or some other policies that haven't yet been scored. So the cut to the health element that I told you about earlier, that's set to save £3 billion in 2029, but it's actually only partly rolled out in that year. And after full rollout, it will save £8.5 billion. So that £5.5 billion difference is actually bigger than the entirety of the package announced yesterday. The tightening of PIP eligibility criteria is dependent upon people getting reassessed. By 2029, I think perhaps a little bit under half of the caseload will still to be reassessed. And when they are, some of them will lose some of their entitlements. And the government has announced plans to scrap the work capability assessments. That amounts to a £2 billion cut before behavioural responses when that is scored. Going in the other direction is a couple of other policies that are yet to be fully specified. So the government is going to have a policy to have an additional premium in universal credit for severe disability, and to introduce a new unemployment insurance scheme. Now, we don't have much details about what these look like yet, but those will tend to serve to increase welfare spending. So bringing everything together, I think the key trade-off that the government is making is to reduce incomes, in some cases really by quite a lot, for those with health conditions. And in return, they get stronger incentives to get into work, more assistance for getting into work for those with health conditions, and weaker incentives to apply for health-related benefits. And I see there as being two key risks to this trade-off. The first is that many of those affected will be very unresponsive to financial incentives and assistance. So for them, it's just a hit to income if they're not able to get into work. And secondly, changes in claimant and assessor behaviour might mean that the hopeful savings don't end up materializing, making the fiscal situation we've just been hearing about trickier still. I'll finish there now and pass back to Paul for questions.
Well, thanks. Thanks ever so much to Isabel, to Bea, and to Tom. Um, fascinating set of presentations. I'm quite a nice set of questions. I'm enjoying the top question here, the most popular question. Is all hope finally lost? Um, I don't know if any of my colleagues want to come in on that. I think probably things aren't quite that bad. Hope is always there, and things might yet turn round. And we're still the OBR is still projecting growth. Household incomes are still likely to be a little bit better at the end of the parliament than they were at the beginning. Hope's probably not finally lost, not all of it anyway. Does anyone else want to say anything cheerful? Has anyone got anything cheerful to say in a general sense?
Well, it's all very uncertain, which I guess is something we always emphasize. I mean, I guess we normally emphasize it somewhat as a negative point, but if you think hope is all lost, then uncertainty in one sense is a positive thing because there's uncertainty cuts in both directions. So there's upside risk as well as downside, I suppose.
I love that. There's uncertainty about whether all hope is finally lost, and that uncertainty is a jolly good thing. Right, let's get on to some more cheerful questions, or slightly more cheerful questions. Again, I'm going to start by taking the top few, and then I'll be a little bit more picky in the ones that we have. So Sushan, I don't know if we know. I mean, I don't have a strong answer to this question, how we expect government employment rights bill to affect the economy and the public finances. Do we agree with the OBR it'll have negative effects? I mean, Tom, can I start with you, and then anyone else who has a view on this can come in? You're on mute. You're on mute, Tom.
Sorry, you wouldn't think we've been doing Zoom for 3 years, 5 years. Um, uh, if you look at what the OBR have to say about the Employment Rights Bill, say, if you make it more difficult for businesses to hire people and to be flexible in who that in labour markets, that's likely to have negative impacts on employment and productivity. And so I think that that makes sense. The policies you can think of as making it more difficult to hire for firms to hire the workers they want or hire them in the way that they want. Of course, it also implies a redistribution between workers and employers and consumers, and so the government might want it on that regard. There's clearly somewhat of a risk, as I say, that it will make things more difficult for firms. And one way that firms could respond, but it would be by reducing overall employment. But I think that's very much it's very much uncertain. We've seen from minimum wage, we don't have enormous impacts from minimum wage rises on employment, and also just the scale, I think, of the impact is also uncertain. So even if directionally this is right, how big a deal of it is it? I think is yet to be seen.
Anyone else any views on that, or should we move on? Let's move on. Question here about Labour's manifesto promises. Which taxes are like to be raised if needed, and what did I mean by speculation might have damaging political consequences? Well, on the second of those, I'm really just thinking back to the period between last July's election and the October budget, when speculation was rife about what the Chancellor might do in that first budget. And if I recall, there was an awful lot of negative reporting about the uncertainty that created, and a lot of political uncertainty at the same time. So I think there's a good chance that the Chancellor is going to be suffering from all sorts of people, including possibly us, speculating about what might happen, and a lot of restiveness potentially among the electorate and her backbenchers and business as a result of that uncertainty. Uh, more importantly, it's pretty clear that these sorts of uncertainties can have direct economic effects. And the most obvious that we saw last year was that a genuinely substantial number of people appear to have changed their pension savings behaviour because they were worried that the Chancellor might change the taxation of pensions, in particular, changing the taxation of the tax-free lump sum. And I mean, you talk to anyone in the pensions industry, and they'll tell you that there was a spike in the number of people withdrawing lump sums in the run-up to that budget. And that's a very damaging thing. And given that she didn't do anything back in that budget, I really wish that the Chancellor had said, and I'm not going to do anything for the rest of this Parliament. But she didn't. So I rather suspect we will have that speculation again. What might, if she does need to increase taxes, what might she do? I don't know. As we know, the manifesto ruled out increases in national insurance, VAT, and income tax, but the budget nevertheless had an increase in national insurance. So we don't know how sacrosanct those promises are. I mean, probably pretty sacrosanct, given the increases in income tax and personal national insurance and so on are likely to be politically very unpopular. If she's left needing to raise really significant amounts, 20 billion plus, then she's going to struggle to get a lot from elsewhere. Now, the easiest political win would probably be to extend by another 2 years the freezes in income tax and national insurance thresholds and allowances. Now, I'm not recommending that as a good policy, but it seems to have come with relatively little political downside. Now, the Chancellor did explicitly not extend those freezes last time round, but if she were to extend them, I think that gets her something like 10 billion at the end of the period, which is pretty helpful. Beyond that, there are more reforms that are needed to capital gains tax, and if you reform that, you might be able to get a little bit of money. There's lots of speculation about wealth taxes, but that's certainly not going to get her a definite amount of money anytime soon. There's all sorts of reforms that need to be made to council tax, for example, that could get you some more money. Seems unlikely that you would raise rates of corporation tax after the big increases we've had in recent years. I could go on and on, but I think the answer is I don't know beyond those sorts of ideas. But one of the reasons that I worry about pension taxation is it looks like a nice juicy place to go for quite a lot of money. But again, not necessarily, in fact, definitely not, depending on how you do it, always a good way of raising money. Stuart is on the line. Do you want to add anything on tax, Stuart?
No, I think you've covered that pretty well, and that there are lots of options. There are lots of smallish options which can add up, but there aren't lots of easy options for big revenue raises. So I won't go through the long list again, but it doesn't look like an easy task, but there are always possibilities.
There are always possibilities. We've certainly discovered that over the years, but there are economically more or less damaging possibilities. And we've also discovered that chancellors have often gone for the less positive ones. Have we all frozen? Have I frozen? No, it's all good. Everyone's just keeping very still. The Chris Smith asking, given is the extra welfare cuts targeted balancing the books on the backs of the poor? Well, I think to repeat what Tom was saying, it is really quite important to be clear that there was a big problem here in the sense of the scale of the increase in spending, the extraordinary increase in the numbers of people claiming these benefits. That said, again, as the chart showed, on average, the people who are losing are relatively poor. So in that sense, it is arithmetically coming from those on low incomes. And my complaint was adding the little bit of extra cuts to balance the books. I think makes it look less like this was aimed at a proper reform and more like it was just about saving money. Tom, did you want to add to that?
I think that's right. It is certainly true that those that are affected are towards the bottom of the income distribution. 3.2 million households losing. I think I said 3.8 in the presentation, so pleased to switch that now. Losing on average £1,700 a year, which is a fairly significant sum. And that is naturally going to be the case if the route you're choosing is cutting benefits, obviously. But it does come against this background, as Paul was saying, of really significant increase in the number of people getting disability benefits. And one policy option is to accept that and say, maybe it's because we're less healthy as a nation, so more people are entitled to these benefits. We'll find a way to save it elsewhere. But the government's response seems to be that they want to at least partly offset that. Although, as I say, it is only partly offsetting it. It's not even slowing. It's not even stopping the rise in spending. It's just slowing it.
And it is worth saying, as you said in your presentation, Tom, that the increase in the basic rate of universal credit is, I think, the first time we've had a real terms increase in that sort of effectively standard out of work benefit in decades.
Yeah, I think it's at least since 1980. It might be longer than that.
So that is a genuine that is a genuine shift, and of course, at least it's possible that part of the issue with the big increase in take up of other benefits is that those standard out of work benefits have become so impossible to live on that you'll essentially, that there's just an enormous incentive to be on the incapacity benefits, which then take you out of the whole system in terms of being in terms of active welfare to work policy. So that there is some. I mean, that's why I say I think some of the changes, whilst harsh on those affected, are certainly defensible from a reform point of view. It's just worrying that some of the additional changes make it look like that was not necessarily the primary objective. There's a couple more questions really about what the best ways of getting back to fiscal balance might be. Is it tax? Is it spending? Which taxes would you prefer? Rather than me wittering on again, Carl, I'm going to warn you. I'm going to come to you to offer your perspective on that. Can one say economically whether tax or spending might be better? If you were going to look for some money, where might you look? Sorry, that's a bit of a hospital pass, but thought you might like a go.
Sorry, where might you look for?
Where might you look for either tax rises or spending cuts? And have you got a view as to whether tax rises or spending cuts might be better economically?
Right. Well, I think you've got to remember the ordering of events matters here. I think the government's already decided to cut pensioner benefits by a small amount. Might be difficult to come back for more. As Tom was talking about, it's done a cut to working age benefits. It's got to legislate that. Might be hard to try and do more there. And in June, it's got to settle, as B set out, quite a difficult spending review. So, assuming the Chancellor gets through that and manages to settle that with cabinet colleagues, it might be hard to come back for more on that side, which basically leaves you in a position of tax rises. There's clearly some tax rises you can do that are really economically damaging. Put up stamp duty, for example. There are tax rises which you can do which will be less economically damaging. Pick a broad-based tax like income tax, national insurance, or VAT and put up the rate. Even better if you reform the tax properly first. On the spending side, again, you've got choices. You could go for a cut to spending that's not going to do much to growth in the UK. For example, if you did decide to come back to working age benefits, if you look at the aid budget, there might be areas there that you can cut where domestic growth isn't going to get harmed very much if you trim a bit. Or you can go for cuts that would be very harmful. You could go for capital spending. That's something which chancellors have often done in the past. And I think something we'd be very complimentary that Rachel Reeves has not done, and that she has topped up the capital spending plans since she came to office and is maintaining capital spending at relatively high levels by UK standards. The last government increased it to a pretty high level, was planning to cut it back, and Rachel Reeves is not pursuing that. So in that sense, she is, that's one area where she is doing a very growth friendly thing.
And maybe if I could jump in on Chris's point about the chances, the 50-50 chances. So that refers to the probability of actually when the future becomes the present, when we get to 2029-30, running a current budget surplus, which is slightly different from the question of what's the chance that in the autumn the OBR will forecast a current budget deficit, of which there is also some chance, but that's not the 50-50 one.
Great, thank you. Um, uh, Anthony Rubin is asking about admin cost cuts. He says here, and I confess I'm not across this, that they're looking to cut admin costs by 15% while cutting only 10,000 jobs. Is that right? And if so, does that sound plausible to you?
I don't think that it's obvious that 10,000 is completely the wrong number. That might be lowballing it a bit, but they're promising to cut admin costs by 15%. The admin workforce is only a share of the overall civil service workforce, and workforce isn't the whole of the administrative budget. So I think that with the two of those combined, it's not obvious that 10,000 is super far off the scale of job losses that might be implied by this, although it definitely is likely to be on the lower end of what might end up being necessary.
I think the key point is it's important to remember there are lots of civil servants who are not doing admin roles.
Yeah.
So if you go to a job centre and you engage with a work coach, if you're in a prison and you're talking to a state employed prison guard, I'm pretty sure they're all civil servants and yet they are frontline staff. So they're not part of the admin bit that the government's looking to cut back on.
Right. Tom, do we know anything about what the Conservative intentions on shake-up of the benefit system were? I mean, can we say that they were different to what Labour was implementing? Well, we know that one attempted reform was ruled out of order by the courts, but anything further to say on that?
Yeah, so one reform that had been put in the scorecard and was cancelled yesterday, as you say, after being flagged by the courts first. That's been undone. But the much bigger thing that was in the Conservative manifesto is they said they were going to cut £12 billion off welfare benefits, and it seemed to be that they had in mind disability and incapacity benefits, but they didn't give any more detail beyond that. So, is this different to what they would have done? Well, we have basically no idea what they would have done. In scale, what we can say is, well, the package yesterday adds up to whatever, 4.5 billion, which is a good way less than 12 billion. But as I was talking about in my presentation, the long run savings from this package actually might be quite a bit more than 4.5 billion, because they take quite a long time to roll out. Maybe once you add those things together, you're not a million miles away from the 12 billion. But yeah, I mean, certainly on what we're going to see, what we're within the forecast period by the end of the decade is much smaller than what the Conservatives have been planning.
Right. Carl, did you have anything to add on that one? That's I know you're across some of this.
Yeah, I mean, I think I'd also add that the Conservative manifesto had said that they would do reform in this area and they would save 12 billion. I think it's fair to say that there were not anything like complete details of how you would bring about that saving. And in fact, some of the 12 billion was about reforms that had already been scored. And indeed, some of it was about reforms that had already been scored, which was subsequently challenged in the courts. So if they had won the election and they tried to implement their 12 billion, they may have been able to get it, but they'd needed to provide a lot more detail, and it might not have been quite as straightforward as what a reading of their manifesto might have implied.
Right. Mauricio Alansar of City AM asks, was what we were saying part on assertion the OBR's powers have become outsized and the forecasts are weighed too heavily. I don't think that the OBR's powers have become outsized. I think what we've seen is a chancellor who has, as we said earlier, said that she's got absolutely ironclad rules, and then sets policy to meet them by the merest sliver of a margin. And so the OBR naturally is going to change its forecast from event to event as the world changes and it changes its judgments. And when you've got almost no room against your targets and you're absolutely set to meet them, then you're almost inevitably going to have to do this kind of fine tuning. So I think Rachel Reeves basically took a gamble in October, which was that things would not things would, if anything, get a little bit better over time in terms of the forecast. And I'm afraid she lost that gamble. But she's maintained the same gamble this time in terms of where things will go in the autumn. And I don't know whether my colleagues would agree with this. I mean, whilst the OBR forecast is a central forecast, or is intended to be a central forecast, it certainly feels from where I'm sitting that the risks are more on the downside than the upside, given what we saw in terms of the productivity numbers. I think we'd be surprised if the OBR upgraded its productivity forecasts, given the risks that have, in a sense, already partially crystallized in terms of President Trump's behavior. Feels to me like there's more chance that things will get worse than get better in terms of the fiscal numbers. Now, Carl, I'll come to you again on that. I mean, is that as I say that, it feels like I'm criticizing the OBR because I'm saying I'm not sure that their forecast is a central one. Did I really mean that?
I think it's fair to say that were you told that in 6 months' time they're going to downgrade, they're going to change their productivity assumption, and you were given a 50-50 bet on is it going up or down, I think I would share your view. I think that the bet should go on down, not up. And in that sense, it doesn't perhaps feel central. I think the big caveat to that is actually there's a huge amount of uncertainty about what's really been happening in the last year to GDP, to the number of people in work, to actual productivity. And there is a chance in a couple of years' time things look a lot better, and we actually realise that the statistics that the OBR and all policymakers are relying on at the moment just aren't as good as they frankly need to be. There are also policy risks which the OBR can't take on board, which also look very skewed to the downside. The chances of Rachel Reeves topping up her public service plans look to me much greater than the chances of her trying to shave more off them. The chances of her freezing field duty look higher to me than the chances of her doing more of an increase than she's currently scored. So I think there's a load of risks there. But I don't think this is the OBR's fault, as you're saying. I think it is the wafer thin margin. And if you very carefully read the new code for fiscal stability, you'll see in a couple of years' time we get to a situation where things are a bit more sensible, I think, in that the Chancellor's saying that she'll target the outlook for 3 years hence, not 5 years hence. So a bit more accountability there. That's nice. But also, while she will make sure she's meeting that rule every autumn in the budget, she's given herself some kind of a margin of error for any spring forecast. So in the autumn, yes, the current budget has to be in balance or better 3 years out. But come the spring, if it's only, say, a bit down, her fiscal rule will not be missed. She does not have to have a current budget surplus in the spring. She'd only have to restore that if the OBR continued to forecast a deficit when it got to the subsequent autumn. So I think that's probably a more sensible way to proceed. And I think maybe a mistake that was made by the government is why didn't we do that straight away? Why didn't we say the spring forecast is not a fiscal event? Yeah, we'll take action if things have changed in a really material way. But if we're only down by, say, 4 or 5 billion, which is what would have happened yesterday if Rachel Reeves hadn't done anything, that will not count as a breach. I will return to it in the autumn if I need to.
Right. The point about the unreliability of the statistics is a genuinely important one. I think the Bank of England, the OBR, the Treasury are struggling to navigate a world in which different statistical series are telling us different things. There have been mistakes in some of these, proving hard to get people to respond to surveys. And so on. Actually, just as the OBR says, genuine uncertainty about what on earth is going on with productivity at the moment, where the ONS is recording big increases in numbers of people in work and reductions in output over the last year. And because we here at the IFS never sleep, we've actually published something else this morning, not related to the spring statement, but an analysis of the latest official statistics on household incomes, the household below average income statistics. Now, those statistics are have historically been the most reliable guide to the distribution of income in the UK, going back many decades. And those statistics show a whopping great fall in incomes last year in 2023, 2024, with an even bigger fall for those for the poorest. Um, but there's a very big but here. We're really not at all sure we believe those numbers because they're not consistent with, for example, tax data. So it's not just in the sort of the macroeconomic policy area, but in terms of understanding what's happening to levels and distributions of income, we are getting very different patterns, pictures from different data sets. And this is all getting very, very murky. Um, I think I'll leave that point there, unless Tom, do you want to come in on that at all?
Yeah, well, just to add that, the government is going to have a child poverty strategy with presumably numerical targets for getting a certain number of kids out of child poverty. And if we can't trust these numbers, we won't know how many are in child poverty, and we won't know whether or not the strategy has worked. They could pass it when they haven't really, or not pass it when they have really, or whatever. What are we to make of that if we can't actually trust them, these statistics that underlie the poverty figures?
Okay, so I'm not going to get anywhere near through this fantastic list of questions, but we will plow our way forward for the next 15 minutes because there are some really good questions here. And Tom, I'm afraid it's you again. A slightly imponderable one. Why are we so ill as a country? And do other countries have such a massive increase in working age disability payments? Well, you and your team have been working on exactly this. So, what do we know?
Yeah, no, good question. Why are so many more people getting health-related benefits? I mean, we don't really know. An easier question to answer is, do other countries have such a massive increase? No, is the answer to that. This is very much a UK phenomenon. Other countries have seen little change or, small rise, small decline since the pandemic, but no one's seen the kind of 30-40% increase in caseload that we've seen. So what's going on? I mean, we do think there's evidence from a number of sources that mental health has probably got worse, and getting on for half of disability benefit claimants get it for mental health. So that might have boosted the numbers, but certainly won't explain the whole thing. Could be that the cost of living crisis had an impact of reduces people's real incomes, and so they look for an alternative way to boost their income and then perhaps apply for these benefits. That's possible. I mean, it's a hypothesis. And of course, it might just be that health is getting worse in other ways. Part of the problem there, as it relates exactly to the last question, is because the surveys that we have become more unreliable and more difficult to compare pre and post pandemic. It's difficult to say on the basis of those whether people's health has been getting worse or not. It's difficult to draw really firm conclusions. So I'd say it's mostly still pretty murky, as you were saying, Paul, as to what's going on here.
Yeah, and what's surprising in a way is that the government hasn't spent tens of millions of pounds actually on investigating exactly what's going on here, given that the tens of billions of pounds that it's cost. But in terms of pure, as you say, statistical sense, arithmetic sense, we know that a lot of this is driven among younger people by big increases in mental health problems that are being claimed for. But we're seeing it across the age groups, across the population, but more concentrated, I think I'm right in saying, in poorer areas and areas that started off with more ill health in the first place. Yeah.
That's right. Go on.
Good, excellent. There's a couple of questions here on growth. So Alex Dismore is asking what other, growth enhancing policies might there be, and Lionel Cassier is asking what about the idea that actually the government's doing some unfriendly things that are unfriendly for growth. I'll start on those and then push it open. In terms of in terms of growth policies, the government is sort of it's a bit of a curate's egg, some good, some bad in terms of their policies. So if you were going to increase taxes a lot back in the autumn and you were really focused on growth, you definitely would not have chosen employer national insurance contributions. You also wouldn't have increased stamp duty on housing, which I think we will all agree is possibly one of the worst taxes you could have chosen to um, increase. If you're really focused on growth, you might not, as we discussed earlier, be significantly increasing regulation on employment or indeed on rental housing. Now, there are trade-offs in all of these things, and the government has chosen a particular trade-off in those areas. Going forward, though, as we've also said, there are some very positive things here. The focus on investment spending, the focus on planning reform, and we'll see whether we get some of the deregulation that the government's talked about. They've talked about deregulation. What they've implemented on the whole so far has been more regulation. What are the things that you might do? Well, I think one answer is you could go quite a lot further, frankly, on planning reform, where the government's clearly making things easier within the current system, but it's not fundamentally overturning the current system and moving to something closer to what most countries do, which is a sort of fixed zoning system. It's still leaving a good deal of choice within it. It's not choosing those bits of the green belt, for example, you might build on according to where they might be most economically valuable. For example, next to commuter stations, it's choosing random bits of the green belt, which at some point in the past might have been a Second World War airfield or a quarry or something, which may have nothing whatever to do with growth, and it's not radically changing some of the change. So you could go further on planning is one answer. You could clearly do things through reforming the tax system to overkill the point. The taxation of housing could certainly do with a change. There are certainly things you could do to change taxation of capital gains, the taxation of the way that self-employed are taxed relative to other people, some elements of the corporate tax system, and so on, and so on. But I'm sure my colleagues, I will shut up. I'm sure my colleagues have got other and more interesting things to say on that. First one to respond gets the first go.
On a perhaps slightly more cheerful note, it is worth noting that if we buy the OBR's forecast for what the existing planning reform does, then that would be an example of the government resolving a trade-off between growth and other objectives by choosing growth. So choosing growth over political obstacles to more house building, choosing growth for the whole economy over a sort of leveling up or regional equality goal by in the OBR's estimation, allowing more people to move to the places where the productive jobs are and allowing the productivity of big cities, the agglomeration effects to play out. So that would be one step in that direction. I think what we would need to see to make an even bigger difference on growth would be to see the government choosing growth over other perfectly legitimate political objectives in more cases. So it's a question of how far are they really willing to go on this.
Stuart, did you want to come in on this?
I guess just to say that there's a whole wide range of policy areas that have an impact on growth, and I haven't mentioned education and skills policy, which is absolutely critical. Things like competition policy and whether we have, whether we have problems in the way we're doing that at the moment. Also related to what we were talking about in respect of the last question, actually a healthier population and more able to work and able to work longer and so on. Now, some of these are outside my own area of expertise in terms of the specific policies that you might want to look at, but there's a whole raft of policy areas and policy levers available to the government. I mean, that list could go on. I think one thing just to emphasise is that quite a lot of these policies can take years to the points of decades to have big impacts. And, if you think about things like education and skills, actually intervention in the early years looks like it can have quite big impacts, but you're not going to see that in GDP until, these people are adults and in the labour force. And I think actually aiming for long run growth is really where we should all be, where we should be about, and where actually part of the reason we've got into the problem that we've got that we're in has been too much of a focus on the short run. And I've been slightly concerned just in the wider policy and media debate how much the question is being put to the government about, well, look at the latest GDP statistics, what's happened to your so-called growth agenda? And I think, well, they've still been in power for less than a year, and what we'd like to be thinking about is policies that really affect the long-run rate of growth in the economy over years or even decades to make a big difference in the long term. So we should have a bit of patience, but there's a lot that could be done in a wide range of areas.
Okay, David Phillips. Hope you're still there and listening. David Phillips is our expert on devolved, all matters devolved, and there is a question here about devolved administrations. Says devolved government grants are set for major cuts. Could a significant drubbing in the Scottish Welsh elections prompt a UK government fiscal rethink? Actually, I think really, David, is a question about what's happening to the budgets of the devolved administrations. Very briefly, can you give us a sense of that?
Yes, so the devolved administrations are not set to see a cut in their overall funding going forwards. In fact, over the last couple of years, like the UK as a whole, there's been an increase in the devolved government's funding. Looking ahead, that sort of 1.2% average real terms increase in departmental expenditure limits for day-to-day spending will result in an increase in the overall funding for the devolved governments. But just like as B was saying, there'll be tough choices about how to allocate that between services. That'll be true for Wales, Scotland, and Northern Ireland. In Scotland in particular, it'll probably be more true, if you like, because of two factors. One is what's called the Barnett squeeze. The funding the Scottish government gets goes up in line with a sort of same per person increase as England gets. But because Scotland starts off with a higher level of funding, that same per person increase is a smaller percentage increase, which makes it harder for the Scottish government to kind of keep up and maintain its more generous level of services over time. So there will be tough choices. The overall funding is increasing, though. The other thing for Scotland, I think, which will be a particular challenge, is the disability benefit reforms. The reforms to PIP won't apply directly in Scotland. Disability benefits are now devolved to the Scottish government. The Scottish government has chosen to make its system a little bit more generous in some respects than the UK system, a little bit easier to claim, less frequent reassessments. That was already set to cost it a few £100 million more than it's getting in terms of funding to help pay for that, which is taking from elsewhere in its budget. Now, with these cuts in PIP at a UK-wide level, that sort of gap is set to increase if these reforms do at least save some money in England and Wales. The Scottish government then faces a choice. Does it cut back on other spending? Does it raise its devolved taxes? Or does it make some cuts to its own benefits? So, big picture, funding is set to increase for the devolved governments, facing the same, perhaps sometimes tougher choices in England on how to allocate that. And disability benefit reform, particularly an issue for Scotland, where they face a choice of do they go ahead with that or make tough choices elsewhere.
Brilliant, thank you. We're at the end, but I'll finish with definitely my favourite question on this list. How will we all cope in the future without Paul being at the helm? I think the question ought to be more, how the hell will Paul cope with not doing this in the future? But the answer, of course, is that the IFS is full of absolutely amazing people, as you've seen just now. We've got a fantastic new director in Helen Miller, and an absolutely wonderful group of colleagues who will all manage, I'm afraid, all too well without me. On that note, I will say thank you very much indeed to Isabel, to Bea, and to Tom in particular, also to Stuart, Carl, and David for taking other questions, and for everyone who has been listening and has been asking those questions. Do keep in touch with all of the other amazing work that we're doing. As I said, even more things already published today, as well as our analysis of the spring statement. Thank you very much indeed, everybody.